Every year, somewhere between 700,000 and 900,000 Americans move money out of a retirement account. They do it carefully. They do it intentionally. They do it because a financial advisor told them to, or because they read an article online, or because they watched a video exactly like this one. And a significant portion of them, by IRS estimates, somewhere around 1 in 5, trigger a tax penalty they did not know existed, did not plan for, and cannot reverse once it has been assessed. The penalty is not small. It is not a processing fee. It is not a late charge. It is a permanent reduction of the retirement funds they spent decades building. And the most important thing to understand about that penalty is this: the people who trigger it almost never made an unusual decision. They made the most normal decision a retiree can make. They simply moved their money. There is a rule embedded inside the United States tax code that most retirement account holders have never been told about in plain language. It was not designed to trap anyone. It was written in 1974 as part of the Employee Retirement Income Security Act, and it has been sitting inside the tax code ever since, updated periodically, referenced constantly in IRS publications that almost no one reads, and enforced automatically, without warning, without appeal, and without exception every single tax season. The rule governs what happens when money leaves a retirement account, and how long the account holder has before that money must either return to a qualified account or be treated as a taxable distribution for the entire calendar year. The window is 60 days. That is the number most people have heard at some point. 60 days to complete a rollover. 60 days to get the funds from one account into another qualifying account without triggering income tax, and a 10% early withdrawal penalty if the account holder is under 59 and a half. 60 days sounds generous. 60 days sounds like plenty of time. For most people who have heard this rule, 60 days is the thing they think they need to know. It is not the thing they need to know. The real danger is not the 60-day window. The real danger is what happens before the money ever reaches the account holder's hands. What happens at the institution? What happens in the processing queue? What happens in a system that most retirees have never seen, never been shown, and never been warned about by the person who told them to do the rollover in the first place? Here is what almost no financial professional mentions at the point of recommendation. When a retirement account holder requests a distribution, not a direct transfer, a distribution meaning the check or the wire is made out to the individual, rather than to the receiving institution. The distributing institution is required by federal law to withhold 20% of the gross amount for federal income taxes. This is not optional. This is not a choice the account holder makes. This is a mandatory withholding under Internal Revenue Code Section 3405, and it happens automatically the moment the funds leave a qualifying account in the account holder's name. That withholding changes everything, because the 60-day clock does not start when the check arrives. The 60-day clock starts when the distribution is made, and the amount required to complete a valid rollover is not the net amount the account holder received. It is the gross amount before the withholding. Every dollar of that withheld 20% must be replaced out of the account holder's own personal funds before the 60-day window closes, or every dollar that is not replaced is treated by the IRS as a permanent taxable distribution for that year. Most retirees do not have 20% of their retirement balance sitting in a checking account waiting to make up the difference. Margaret is 64 years old. She lives in a 2-bedroom house in Knoxville, Tennessee that she and her late husband bought in 2001. She receives a Social Security survivor benefit of $1,640 per month. In February of this year, Margaret called her retirement account custodian and asked to move her entire IRA balance, $218,000, to a new institution that had offered her a higher interest rate on a rollover IRA. The customer service representative walked her through the paperwork. The representative confirmed the 60-day rollover window. The representative did not mention the mandatory 20% withholding. The check that arrived in Margaret's mailbox 11 days later was not for $218,000. It was for $174,400. And the 60-day clock had already been running for 11 of those days. Margaret did the math sitting at her kitchen table with a calculator she had owned since 1997. She needed $43,600 in personal funds money that was not in the check, money that had been withheld by the custodian before it ever reached her to complete the rollover in full. She had $11,200 in her checking account. She had a savings account with $6,400. She had a small certificate of deposit that would not mature for another 4 months and carried an early withdrawal penalty of its own. She was $26,000 short. She called the new institution. The representative there confirmed what she already feared. The full $218,000 had to arrive in the new account before the 60-day window closed. Not $174,400. Not whatever she could piece together from her personal accounts. The full original gross distribution amount. That was the IRS requirement. There was no exception for good faith. There was no exception for not being told. There was no exception for the fact that a customer service representative at the original institution had walked her through the process step by step and had not mentioned in any part of that conversation that 20% of her retirement savings would be withheld before she ever saw the money. Margaret completed the rollover with $196,800. She pulled every dollar from her checking account and her savings account and deposited it alongside the net check. The remaining $21,200 that she could not replace within the window was treated by the IRS as a taxable distribution for the calendar year. At Margaret's income level, that amount was taxed as ordinary income at 22%. The bill was $4,664. It arrived the following April. It was not a penalty line on her return. It was simply income she had not planned for, income she had not earned, income that existed only because a system she did not know about had quietly taken 20% of her retirement savings before handing her the rest. She paid it. She is not unusual. The IRS processes hundreds of thousands of cases involving incomplete rollovers every year. The agency does not flag them as errors. The agency does not send warning letters before the 60-day window closes. The agency simply processes the tax return that arrives in the spring, identifies the distribution amount, identifies the rollover amount, calculates the difference, and assesses the tax on whatever was not returned to a qualifying account. The process is entirely mechanical. There is no human review. There is no consideration of intent. There is no mechanism for the agency to know or care that a customer service representative did not mention mandatory withholding during a phone call in February. Thomas is 71 years old. He lives in a rental apartment in St. Louis, Missouri. He receives Social Security retirement income of $2,240 per month and a small pension from a manufacturing company that closed its local plant in 2009. In 2023, Thomas inherited an IRA from his younger brother, who passed away unexpectedly at 67. Thomas was named as the sole beneficiary. A colleague at his former workplace told him that he should move the inherited IRA into his own IRA to simplify the paperwork. Thomas called his brokerage, requested the transfer, and was told the funds would be moved within 10 business days. What Thomas did not know, and what his colleague did not know, and what the first representative he spoke to at the brokerage did not immediately clarify, is that an inherited IRA cannot be rolled over into the beneficiary's own IRA at all. That option was eliminated for non-spouse beneficiaries under the Secure Act of 2019. A non-spouse beneficiary who receives an inherited IRA must keep it in a separate inherited IRA account governed by specific distribution rules, or transfer it directly to another inherited IRA account at a different institution. The moment those funds are distributed to the beneficiary personally, the moment they leave the inherited account and pass through the individual's hands, the rollover option disappears entirely. There is no 60-day window for an inherited IRA distribution to a non-spouse. The distribution is immediately and permanently taxable. Thomas received a check for $67,000 after mandatory withholding. He deposited it into his own IRA within 30 days, believing he had completed the rollover correctly and ahead of schedule. He had not completed a rollover. He had made a taxable distribution of $83,750, the gross amount before withholding, and then deposited personal funds into his own IRA, which the IRS treated as a regular IRA contribution, subject to annual contribution limits he had already exceeded for that year. The tax bill, penalties, and excess contribution fees that arrived the following spring totaled just over $19,000. Thomas had done exactly what someone told him to do. He had moved quickly. He had been careful. He had called his brokerage. And every step he took in the right direction, by the logic of what he understood, moved him further into a consequence he had no framework to anticipate. These are not edge cases. These are the cases that accountants who work in retirement income filings see in the first quarter of every calendar year, after the previous year's distributions have been processed and the tax forms have arrived, and the retirees who made the moves are now sitting across a desk, trying to understand why a decision they were told was straightforward has produced a tax liability they cannot easily pay. So here is what to do instead. And the sequence of these steps matters as much as the steps themselves. The first and most important decision in any retirement account move is the method of transfer. There are two methods. The first is an indirect rollover, the one Margaret used, where the funds are distributed to the individual, and the individual is responsible for redepositing them within 60 days. This method triggers mandatory 20% withholding and creates the gap problem described above. The second method is a direct rollover, sometimes called a trustee-to-trustee transfer, where the funds move directly from the sending institution to the receiving institution without ever passing through the account holder's hands. In a direct rollover, no withholding is required. No 60-day clock applies. No gap exists between the gross amount and the net amount because there is no net amount. There is only the full gross balance, moving from one qualified account to another in a single transaction. Request the direct rollover in writing, not over the phone, not through an online portal alone. In writing, with a confirmation from the receiving institution that they are prepared to accept the funds as a direct rollover and will apply them to the correct account type. That written confirmation is the document that protects you if the transfer is misclassified on either side. The second step applies specifically to inherited accounts. Before any inherited retirement account is moved, transferred, or touched in any way, verify in writing whether the account is subject to the 10-year distribution rule under the Secure Act, the Secure 2.0 Act, or the original pre-2019 inherited IRA rules, depending on the date of the original account holder's death. The rules are different depending on that date. They are different depending on the relationship between the beneficiary and the original account holder. And they are different depending on whether the original account holder had already begun taking required minimum distributions. These are not details a customer service representative at a brokerage is required to explain to you before processing your request. They are details you are responsible for knowing before you make the request. The third step is the one almost no one takes, and the one that eliminates the largest category of preventable loss. Before any distribution is requested, before any transfer is initiated, before any paperwork is signed, call the receiving institution and ask them this exact question. Will this transfer be classified as a direct rollover on IRS Form 5498, and will the sending institution receive written confirmation of that classification at the time of transfer? If the answer from either institution is uncertain, do not proceed until it is certain. The classification on Form 5498 is the record the IRS uses to determine whether a rollover was completed correctly. If that form is wrong, the tax consequence follows automatically, regardless of what actually happened. The retirement system in this country is not designed to explain itself. The rules exist in publications and statutes and tax code sections that are publicly available and deliberately unreadable. The institutions that hold retirement funds are required to process the transactions you request. They are not required to identify the transactions you should have requested instead. That distinction between what they process and what they are required to tell you is where the loss happens. Every time. Margaret did not make a reckless decision. Thomas did not make a careless one. They made the decisions that made sense given the information they had been given. The information they had been given was incomplete, and incomplete information inside a system that enforces its rules automatically and without appeal is not a small problem. It is the mechanism through which ordinary, careful, responsible retirees lose money they spent their entire working lives building. The move itself is not the danger. The method is the danger. The classification is the danger. The assumption that the person on the other end of the phone will tell you everything you need to know before it is too late. That is the danger. Know the method before you make the move. Get the classification in writing before the funds leave. And never let money you have spent decades building pass through your hands when there is a direct path that does not require it to. That is not financial advice. That is the architecture of the rule. And the rule does not care whether you knew it existed.